The core confusion in accounting. One of the most common conceptual difficulties faced by students of accounting is understanding why the capital introduced by the owner is treated as a liability in the books of the business. At first glance, this treatment appears contradictory because capital represents the owner's own money and not an amount borrowed from outsiders. Since liabilities are generally understood as obligations toward third parties, students naturally assume that capital should be shown as an asset or at least not as a liability. However, accounting is not based on personal assumptions or emotional understanding. Instead, it is built upon clearly defined principles and logical reasoning, and when these principles are applied correctly, the classification of capital as a liability becomes both reasonable and necessary. Meaning of capital in accounting. In accounting, capital refers to the amount of money or value of assets that the owner invests into the business for the purpose of starting operations or continuing business activities. This investment may be made in the form of cash, bank deposits, machinery, land, buildings, or any other resource that can be used by the business to generate income. Capital forms the financial foundation of the business and enables it to acquire assets, meet expenses, and carry out daily operations. Although capital originates from the owner, once it is introduced into the business, it becomes part of the business records and must be accounted for according to accounting rules rather than personal perceptions. The business entity concept, the fundamental principle. The most important principle that explains the treatment of capital as a liability is the business entity concept. According to this concept, the business is considered a separate and distinct entity from its owner, irrespective of whether the business is a sole proprietorship, partnership, or company. Even in the case of a single-owner business, accounting assumes that the owner and the business are two separate entities for the purpose of recording and reporting financial transactions. This separation is not physical or legal in nature but conceptual and accounting-based. It allows accountants to clearly identify business income, business expenses, business assets, and business obligations without mixing them with the personal finances of the owner. Effect of the business entity concept on capital. Once the business and the owner are treated as separate entities, the nature of capital changes entirely from an accounting perspective. When the owner introduces capital into the business, it is viewed as a transaction between two different entities. From the owner's point of view, capital is an investment made to earn profit and increase wealth. However, from the business's point of view, capital is an amount received from the owner which the business is obligated to repay or return, either through withdrawals, distribution of profits, or settlement at the time of closure. This obligation transforms capital into a liability in the eyes of the business. Understanding liability in accounting terms. A liability in accounting refers to a present obligation of the business arising from past transactions, the settlement of which is expected to result in an outflow of economic resources in the future. When capital is introduced by the owner, a past transaction takes place in which the business receives resources from the owner. In return, the business acknowledges an obligation toward the owner. This obligation may not require immediate repayment like a bank loan, but it still exists in the form of the owner's claim on the business assets. Therefore, capital satisfies the essential definition of a liability. The obligation of the business toward the owner. The obligation of the business toward the owner exists in several practical ways. The owner has the right to withdraw capital either partially or fully, subject to business conditions. The owner is entitled to receive profits generated by the business because profits belong to the owner and not to the business as an independent entity. In the event of dissolution or closure of the business, the remaining assets after settling external liabilities must be returned to the owner. These rights of the owner clearly indicate that the business owes something to the owner and any amount owed by a business is classified as a liability. Capital as a claim on business assets. Capital represents the owner's claim against the assets of the business. Assets are resources owned and controlled by the business, but these assets are financed either by outsiders or by the owner. Outsiders such as creditors and lenders have claims in the form of liabilities, while the owner has a claim in the form of capital. Both claims compete over the same pool of business assets. Since capital represents a claim and not ownership by the business itself, it is logically placed on the liabilities side of the balance sheet. Accounting equation and logical consistency. The accounting equation clearly demonstrates why capital is treated as a liability. According to the equation, assets are always equal to the sum of liabilities and capital. This equation shows that assets are financed by two sources: funds provided by outsiders and funds provided by the owner. Capital is shown on the same side as liabilities because both represent sources of funds and claims against assets. Treating capital as anything other than a liability would disrupt the balance and consistency of this fundamental equation. Why capital is not treated as an asset? An asset is something that the business owns and controls and from which it expects future economic benefits. Capital does not meet these conditions because it does not belong to the business in an absolute sense. The business cannot claim permanent ownership over capital since the owner retains the right to withdraw it and to claim profits. The business merely uses the capital to carry out operations but does not own it in the same way it owns machinery or inventory. Hence, capital cannot be classified as an asset. Difference between capital and external liabilities. Although capital is treated as a liability, it differs significantly from external liabilities such as loans and creditors. External liabilities must be repaid within a fixed period and usually carry a fixed rate of interest. Capital, on the other hand, does not have a fixed repayment schedule and carries the risk of business loss. In case of liquidation, external liabilities are settled first, and only the remaining assets, if any, are used to repay capital. Despite these differences, both capital and external liabilities represent obligations and claims against business assets, which justifies their placement on the same side of the balance sheet. Legal and financial reporting perspective. From a legal and financial reporting standpoint, capital is referred to as owner's equity or shareholders' funds. Equity represents the residual interest of the owner in the assets of the business after deducting all liabilities. Even though equity is conceptually different from external liabilities, it is still a claim against the business. For this reason, financial statements group equity under the broader heading of liabilities to show all claims on business assets in one place, thereby ensuring transparency and clarity. Importance of treating capital as a liability. Treating capital as a liability plays a crucial role in maintaining accurate accounting records and meaningful financial statements. It ensures that personal and business finances remain separate and prevents the misuse of business funds for personal purposes. It also allows users of financial statements to understand how much of the business assets are financed by the owner and how much by outsiders. This treatment improves comparability, accountability, and reliability of financial information. Conclusion: the final accounting logic. In conclusion, capital introduced by the owner is treated as a liability because accounting views the business and the owner as separate entities. Capital represents an obligation of the business toward the owner and a claim on the business assets. It fits perfectly within the accounting equation and ensures logical consistency, transparency, and accuracy in financial reporting. Although capital is a sign of ownership and strength for the owner, from the business's point of view, it remains a liability that must be acknowledged and reported correctly.